Welcome, YouTube family, and welcome to another edition of the Kevin Strong Show. I am your host, Kevin Strong, and in this video, we're going to talk about the Rocket Mortgage 1% down payment program. I am not a fan of it. I think it's setting people up for failure, but we're going to go ahead and discuss that, talk about FHA and VA loans and things of that nature. So if you're enjoying this type of content, please do me the honor of smashing that like button, hitting that notification so you are notified when I do release my video, which is typically once a week. So without further ado, we're going to go ahead and get into this video. It's called the Rocket Mortgage 1% Down Payment Program, but I'm revising that language and calling it the 1% Trap. So let's go ahead and get into this. So some points I want to discuss. Rocket Mortgage is offering a new program that allows low to moderate income home buyers to put down as little as 1% on their dream home. So on the surface, this looks like a wonderful opportunity that Rocket Mortgage is just reaching out to those who are struggling a little bit to give them an opportunity to get into home ownership. Not to mention that I'm sure there's some social and political benefits to offering a program like this. But at the end of the day, if it doesn't make money, it doesn't make sense. This is a recipe for disaster. Typically speaking, if you do have to sell a home, you're looking at 6% in real estate commissions, another 2 to 3% in closing costs. So if you're putting under 10% down and you have to sell your house without experiencing any appreciation, you're already underwater even before you move in. So Fannie Mae and Freddie Mac are two government entities that basically buys most of the mortgages. So a non-traditional bank like Rocket Mortgage, I shouldn't really call them a bank because they're not, but they sell this stuff, the mortgages that they originate, to the secondary market. And typically the main two buyers on the secondary market is Fannie Mae and Freddie Mac. So you have to make sure that that loan is compliant in order for them to buy that mortgage on the secondary market. It frees up your liquidity so you can rinse and repeat. So how is Rocket Mortgage going to make sure that these creative programs that they're offering these folks are Freddie Mac and Fannie Mae compliant? Rocket will pay 2% of the borrower's loans, okay? And they're going to absorb the mortgage premium. So as you may or may not know, if you're putting down less than 20%, the lender is going to require private mortgage insurance because that's considered a higher risk loan, with the exception of VA, which does not have private mortgage insurance, and VA is no money down. But VA is very different from this 1% program. So stick around to the end of this video so I can explain the reason why. We are not reducing the qualifications and putting people into loans they can't afford. Once again, I'm going to push back on this strongly because I think you're dealing with increase in property taxes, homeowners insurance premiums are going up, you have maintenance costs, food costs, all of these inflationary pressures that eat away at your disposable income. So folks, you can't just get fixated on the payment. It's the maintenance and those other things that you have to spend money on that ultimately determines whether or not you're in a good position for home ownership. You don't make that decision purely based on the payment. And I think that's where a lot of people get sidetracked. So how do you qualify for this program? Sorry that this slide here is kind of overlapping a little bit, but home buyers who are purchasing single family and manufactured homes that have an income of 80% or less in their medium income area, that's the financial means test to qualify for this Rocket Mortgage program. And they're estimating that because they're rolling out this program, it's going to open up opportunities for 90 million people to potentially take advantage of this program under this guideline. So historically speaking, according to the National Association of Realtors, the average down payment is 6 to 7%. So obviously by coming up with a 1% program, that's going to widen your net of potential applicants. As I've indicated earlier in the video, VA loans are no money down and no mortgage insurance. And I just wanted to be transparent about that because some people think, well, why aren't you giving VA a lot of grief? Those are low, no money down programs. So nobody's screaming about that. But like I said, stay tuned to the end of this video and I'll explain why that is an outlier. There's a reason for that. So there's other lenders that are doing some creative programs. Last year, Bank of America, and they said, hey, we're going to come up with a zero down payment mortgage with no closing costs for first-time home buyers in the area of Charlotte, Dallas, Detroit, Los Angeles, and Miami. And yes, they were least upfront about their intentions. If you got the complexion for the connection, AKA if you're Black or Hispanic, you qualify if you reside in one of the aforementioned cities. Now, in San Francisco has a federal credit union that also offers a mortgage of 0 down payment, but this one's a little bit different. It is an adjustable rate, so your rate's only going to be fixed for 5 years, and thereafter it's going to continue to adjust for the life of the loan unless you convert it to a fixed rate program. So what are some final thoughts that I have? Rocket Mortgage is one of the biggest non-bank mortgage lenders in the U.S. And this quarter, in the first quarter of 2023, guess what? They lost $411 million. So that's probably a good reason why they're trying to come up with some creative loan products to increase their bottom line. While the program like this isn't going to solve the supply problem in America, Walter says, this is a representative from Rocket Mortgage, what it does is it levels up some of the folks who really are struggling in a market that's often competitive and where prices have risen. Now, I put this not in quotes, but in parentheses. Rocket is betting on a continued growth. So they're betting on, hey, don't worry about being upside down, putting 1% down, even though it takes 8% to sell your house, because you're going to make that up over the long haul through appreciation. But if you're buying at the top of the market, you're already not only underwater, but you're compounding your problem if you buy in a market that's experiencing a decline. In October of last year, delinquency rates were basically down in the fourth quarter of 2023 for FHA, VA, and conventional loans, respectively. I'm just summarizing that bullet point. I think that is a false positive because there's just a lot of lenders that are just now getting aggressive in terms of starting the foreclosure procedures. They're less likely to work out loan modifications unless you really know what you're doing. That's something that we specialize in. That's why the tagline at the bottom of this video is preventforeclosure.us if that's something that you're interested in. Now we're going to get to the part about the VA aspect of this. CoreLogic data shows that the Sears delinquency rate for FHA loans was about 5 times higher than the Sears delinquency rate for conventional loans. To note, Sears delinquency rates for FHA loans have historically been higher compared to other mortgage types. So here's the outlier with the VA loan. Here's the reason why, in my humble opinion, I haven't done any research on this. This is why I think the VA loan, not only I think it's a solid program, but why the delinquency rate and the foreclosure rate as it applies to a VA loan is significantly lower than FHA. The majority of folks who use a VA loan are active duty service men and women that are in the military. So their money's pretty much guaranteed. They don't have a disruption in their income. So they're less likely statistically to default on a VA loan. Those VA loans that do fall into delinquency and or ultimately end up being in a foreclosure stat typically are people who used to be in the military, such as myself, that does qualify or did qualify for a VA loan. You go out and use your VA loan, but now you're a civilian employee, you run into an illness or you lose your job, and as a result, you fall behind on your mortgage payments, and ultimately the bank comes back and takes over the property and you are a foreclosure statistic. So that's the exception, but the lion's share of VA loans are active duty servicemen and women. And as I said earlier, this is the reason why, even though VA is no money down and no mortgage insurance, statistically speaking, when you compare that program to FHA, the delinquency rate and the foreclosure rate is much, much, much lower. So I hope you guys got some good information out of that. If you are enjoying my content, please do me the honor of smashing that like button, comment and share before I care, hit that notification button so you do find out when I am releasing my videos. As I said, I typically do this once a week, and I'm going to share some personal things with you right now that I think is just a good thing to do as a YouTuber, that it's to humanize your experience with your viewing audience. This is way, way down the line, but I'm getting very interested in contemplating retirement in the next 5 years. But I'm thinking about retiring to an island called Crete, and that is in Greece. Woo! So don't be surprised if your temperature starts to rise. It's a beautiful, beautiful, beautiful country. I'm probably going to spend 2 or 3 weeks there next year to kind of get an opportunity to kind of look around and see what that's like. And I'm actually thinking about if I do decide to retire there in 5 years, I'm actually going to think about opening up a business in that island. So really excited about that. That's something that just came to me just a couple of days ago. The business aspect of it is something that I'm been thinking about for actually quite a bit of time now. It's just so much stuff going on in the US, and I'm just not a fan of that. And just anyway, so stay tuned for that. So I'm going to leave you with my famous quote: keep your credit score up and your debt down. This was the Kevin Strong Show. I hope you enjoyed my content, and I hope to see you in the next video.